Remember that Friday night feeling? You're finally winding down, maybe checking the markets one last time, when a news alert flashes across your screen. Trump threatens new 25% tariffs on all Chinese imports. The market is already closed, but the futures market is screaming red. Panic sets in. You watch the S&P 500 futures plummet, taking the Nasdaq down with it. It's a collective gut-wrenching moment. You spend your entire weekend calculating the damage, convinced the Monday morning open will be a financial bloodbath, a repeat of the worst trade war crises. But then Monday arrives. The closing bell rings, and the market hasn't crashed. In fact, it rebounded. The S&P 500 surged, and the tech-heavy Nasdaq led the charge, wiping out most of Friday's losses. How? Why does this political volatility follow such a predictable pattern? It's not luck. It's a calculated, observable phenomenon on Wall Street, and understanding it is the key to turning political fear into profit. My name is Nick, and for years I've watched as fear-driven retail investors sold at the worst possible moment, while institutional traders calmly bought the dip. They weren't smarter, they just knew the formula behind the chaos. Today, we're breaking down the mechanics of the Trump-China market scare and revealing the insider term for this predictable rebound, the taco trade.
Let's first establish the pattern. When President Trump was in office, his strategy of choice for trade negotiations involved the element of surprise and maximal pressure. And the optimal time for maximum pressure? Late Friday afternoon. He knew that a major tariff threat announced after the closing bell would give investors the entire weekend to panic, amplifying the shock. This tactic weaponized the weekend. The S&P 500, the index representing the 500 largest U.S. companies, and the Nasdaq, dominated by major tech stocks with massive global supply chains, were the two biggest victims. The initial reaction was always swift and severe. Analysts would rush to downgrade growth forecasts. Tech stocks, reliant on manufacturing in China and selling products globally, would take the deepest dive. The average S&P 500 plunge following a major Friday tariff tweet was consistently above 1.5% in futures trading. This initial drop wasn't driven by fundamental economics. It was driven by fear. Retail investors, lacking context and facing the unknown of a two-day waiting period, would often dump their positions the moment the market opened on Monday, just before the rebound began.
Now, here's where the political strategy kicks in. The market is plunging, the media is sounding the alarm, and the administration has achieved maximum leverage. Over the weekend, a crucial psychological shift would occur. Anonymous sources would start appearing in major financial publications. Administration officials suggest comments were merely a negotiating tactic, or the president is expected to meet with advisors before implementing the full scale of the threatened tariffs. These seemingly small, softening comments, often delivered via a casual tweet or a brief remark, were a deliberate attempt to manage expectations and provide the nervous market with a narrative of control. The message, the crisis is manageable, and the threat might not be absolute. This subtle shift didn't resolve the trade war, but it accomplished one vital task. It defused the immediate existential panic that had been built up over the weekend. This is the moment when smart money begins to move.
Monday morning, the market opens. The initial rush of panic selling often occurs, but it's quickly met by aggressive buying. In instances where a major trade war escalation was threatened on a Friday, the subsequent Monday almost always saw a strong rally. We saw instances where the Nasdaq, specifically, surged by 2.2% or more, completely overshadowing the S&P 500's 1.6% gain. Why did the Nasdaq perform better? Because its decline was often overdone on the Friday. Tech giants, being the most exposed to global supply chain risk, were sold off disproportionately hard. Once the political rhetoric softened, the potential reward of buying those oversold positions was far greater. This is the pattern Wall Street quickly learned to recognize, and they gave it an appropriate, if slightly cynical, nickname: the taco trade. It wasn't that he abandoned the tariffs entirely, but he rarely, if ever, followed through on the most extreme, market-crippling threats exactly as they were initially delivered. The full 25% tariff on all imports rarely materialized immediately, and the threat was often delayed, creating a massive short-term buying opportunity. To truly capitalize on the taco trade, you have to understand the Nasdaq's unique vulnerability. Tech stocks like Apple, Microsoft, and Nvidia operate on thin margins across complex, highly optimized global supply chains. A 25% tariff on component parts doesn't just cut into their profit. It forces a massive, costly re-engineering of their production line, a logistical nightmare. When a tariff threat emerges, the market prices in this logistical nightmare immediately. This is why the tech sector drops hardest. But when the threat softens, even marginally, the market breathes a sigh of relief. Traders immediately reverse their extreme positions, leading to a massive, swift upswing. The size of the initial drop is directly correlated to the size of the rebound. Because tech fell the farthest on fear, it rises the fastest on relief. This isn't about the long-term trade war resolution. It's about a short-term, predictable correction of an overreaction.
Now, how can a strategic investor use this historical pattern? This is the playbook for turning political noise into financial signal. Rule 1. Don't sell on Friday fear. If you see a major tariff or political threat after the market closes, do nothing. Selling on the initial spike of panic ensures you lock in a loss that the market often reverses within 48 hours. Your biggest enemy here is your own emotional reaction. Rule 2. Identify the overbought sector, the Nasdaq. When the fear subsides, the Nasdaq often leads the charge. If you're a shorter-term trader, the tech index, or a broad tech ETF, is your best bet for the Monday rally due to its exaggerated volatility, both up and down. Rule 3. Look for the softening signal. The rebound doesn't happen without a signal. Look for Sunday night or Monday morning news reports that include phrases like negotiations ongoing, delay possible, or awaiting official directive. These are the green lights institutional money uses to start buying. Rule 4. Understand the difference between noise and signal. The taco trade is a market volatility play, not a long-term investment strategy. The trade war risks are real, but the sudden, sharp drops often represent political noise that temporarily overshadows the underlying value of the companies. You are buying the temporary psychological discount, not the permanent economic resolution.
Ultimately, the greatest lesson from the S&P 500 and Nasdaq's reaction to Trump's China comments is that emotional volatility creates the best trading opportunities. Fear drives retail investors to sell. Understanding the predictable political script drives strategic investors to buy. By recognizing the taco trade, the predictable dip on Friday threats, and the powerful rebound on Monday signals, you can stop being a victim of headline news and start using that news as a tool. If this analysis helped you see market volatility in a completely different light, please hit the like button and subscribe for more insider strategies that turn common knowledge into trading advantage. Let me know in the comments below, what was the scariest market headline you ever sold into?